Tsakos did a 5-1 reverse stock split earlier this year. The main reason companies do reverse stock splits is so they don't get delisted. A company gets delisted when its stock price is below $1. Let's value this company to figure out whether it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Tsakos Energy stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. Tsakos is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a really small company, 157 million market cap. They're trading at $8.36 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding 19 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows, then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things without taking on more debt. And this company has negative free cash flow in 2016 and 2017, but positive in 2018 and 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And this company has positive net income in 3 of the 4 years, negative in 2018. We'll look at their financials in a little bit to figure out why. Their revenue looks okay. It's growing from 482 million to 597 million, so it's moving in the right direction. Let's look at their financial statements. Let's see why the company had negative net income in 2018. So you can see the top line is revenue. Below that is cost of revenue. That's how much money it cost this company to generate the revenue. The difference is gross profit. Below that is operating expenses. These are all the expenses not directly tied to making the products. Then below that is operating income. You want to make sure operating income is positive, and it is positive in each year, although it's pretty low in 2018. They paid $73 million of interest on their debt, so the interest payments were more than operating income. This is the only year we can see that they had more interest payments than operating income. You want to have a pretty good spread between operating income and interest payments because you have to pay taxes and dividends. What made their net income even worse was the asset impairment of $65 million. If there is a piece of machinery that you can buy for $1 million in the open market, but on your balance sheet it's $2 million, what you would have to do is you would have to reduce the value on your balance sheet from $2 million to $1 million, then pass through a $1 million loss onto the income statement. That's what this company did in 2018. It passed through $66 million of impairment losses. These are non-cash items since you paid for the assets in the past. This is more of an accounting thing. So I could show you in the statement of cash flows where it adds back the $65 million impairment. The operating cash flow starts with net income, negative $101 million, then adds back the non-cash items from the income statement. The $137 million was depreciation and the $65 million was the asset impairment. So you want to look at operating cash flow. That's a better indicator of a company's health than net income because net income has a lot of non-cash items, so it's more accounting. You really want to focus on cash. And to calculate free cash flow, it's cash flow from operations, which is the top line, minus capital expenditures. So the reason they had negative free cash flow in 2017 and 2016 was because of their really large CapEx spending. So it is good to see the company had positive operating cash flow in all the years. They just invested a lot back into their business. CapEx are investments in property, plant, and equipment. The entire amount is recorded in the cash flow from investing section in the year the asset was purchased. CapEx is capitalized, which means it is recorded as an asset on the balance sheet. It is depreciated over its useful life, so each year part of the value of the asset is deducted from the balance sheet and passed through onto the income statement as an expense, so it brings down your net income. CapEx is generally considered a positive thing since the company is investing in their operation and grow it. When analyzing CapEx, you should consider 2 factors. Will this item provide the company with a good return on investment? And what is the opportunity cost? Meaning, would the company be better off if the cash was used for something else? Let's look at a capital structure. $1.5 billion of debt, $1.5 billion of equity. They pay 4.49% interest on their debt, and 51% of that capital structure is debt, which means 49% is equity. To get the cost of equity, we use the capital asset pricing model, and part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. The S&P as a whole has a beta of 1. This stock has a beta of 0.62, so the stock moves less than the market, so it's not volatile. The WACC is 5.76%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $278 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $336 million. We divide that by 19 million shares. We get a calculated stock price of $17.92. They're trading at $8.36, so they're trading at a 53% discount. It's a buy according to the model. Simply Wall Street is even higher. They're at $32 a share, so they're saying the stock is 74% undervalued. Let's see where the stock has been trading the past few years. So since the company did a 1-for-5 reverse stock split, these numbers were never this high. So you have to divide these numbers by 5 to get a better indication of where the stock really was. So it looks like the stock dropped a lot in 2015, was fairly steady, coming down little by little each year. It's coming down a little more aggressively the past 12 months. Let's look at the historical dividends. So they were paying 40 cents a dividend back in 2015 and 2016. They cut it to 25 cents end of 2016 and was at that level for 3 years, but they did increase it recently, which is interesting, to 38 cents a share. So they have a pretty high dividend yield, 13.46%. To calculate dividend yield, it's annual dividend over stock price. So as the stock price comes down, the dividend yield comes up. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $2,158 today. That's a 78% loss, or 14% loss per year. If you did not reinvest the dividends, you'd have $33.63. That's a 66% total loss, or an annual loss of 10%. Obviously, the stock has not been performing well, but it's up to you as the investor to decide, will it get better or will it continue to slide? It is good to remember that a company's financial performance is not 100% correlated to changes in the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers, and the stock price will go down if there are more sellers than buyers. The market is forward thinking, so you have to try to understand market sentiment. That's part of investing. Let's look at their financial ratios. They have really great price multiples. The average PE in the market is 17.4. The median is 15.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 11.2, so investors are paying $11.20 for $1 of earnings. Price to sales median is 2.0, the average is 4.6. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.3, so investors are paying 30 cents for $1 of revenue. Median price to book is 2.3, the average is 4.7. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 0.1, so investors are paying 10 cents for $1 book value. Equity is total assets minus total liabilities on a balance sheet. The average interest coverage ratio is 12.7. The median is 3.9. Interest coverage ratio is EBIT over interest expense. They're at 1.6, so they can cover their interest payments, but not a lot left over. EBIT is earnings before interest and taxes. It's called operating income on the income statement. The average ROE is 13%, the median is 12%. ROE is net income over equity. They're only at 1%. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities, so they can just cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payable due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on 42 oil and gas midstream companies, and Tsakos is right here. And if Tsakos has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in PE because the average is really low at 5.0. They're doing really well in price to sales and price to book. Current ratio, they're a little worse than average. ROE, they're not doing well. Debt, they are better than average at 51%, average is 63%, and they're a really small company, much smaller than the average. But they do pay a higher dividend, over 13%, average is 12%. So to summarize, I do have them trading at a 53% discount because their stock price is so low. Their ratios look okay, but their financials look a bit weak. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you could become a member by clicking on the link in the description below. Every month, I will provide my members with an Excel file to help them better analyze stocks. Thanks for watching.